Good morning, everyone. The US Federal Reserve recently made a significant decision to cut interest rates by half a percentage point, marking the beginning of a new phase in its economic strategy. After 2 years of battling high inflation, this decision signals that the central bank is shifting its focus towards maintaining economic stability. But why is this change so important, and how might it impact the economy? The Federal Reserve, which is the central bank of the United States, decided to reduce interest rates by 0.5%. This move lowers the federal funds rate to a range of 4.75% to 5%, making it the first time in over 4 years that such a cut has been made. The decision reflects the Fed's desire to prevent any potential weakening of the US economy and the labor market after an extended period of high interest rates. The Fed Chair, Jay Powell, emphasized that this shift aims to keep the economy strong while continuing efforts to control inflation. The last time the Federal Reserve made a similar cut was during the pandemic in 2020, when the global economy was facing serious challenges. Now, inflation, which reaches its peak in 2022, has begun to ease with current levels closer to the Fed's target. However, the labor market is showing signs of slowing, and the Fed wants to avoid further damage. By lowering borrowing costs, the Fed hopes to encourage more economic activity, such as investment and consumer spending, which can support both businesses and workers. When the Fed cuts interest rates, borrowing becomes cheaper for everyone, from businesses to individuals. Lower rates can help stimulate spending, which in turn can boost economic growth. However, it's not without risks. If inflation proves to be more persistent, the Fed might have to adjust its policies again. On the other hand, a continued slowdown in the labor market could mean that the Fed will have to lower rates even more in the future. The Federal Reserve has signaled that more rate cuts may be on the way. By the end of 2024, officials expect the rate to fall further to a range between 4.25% and 4.5%. This gradual reduction is part of the Fed's ongoing strategy to balance inflation control with supporting economic growth. Policymakers also predict that the unemployment rate could rise slightly, but overall, they expect the economy to stabilize with steady growth over the next few years. The Fed's decision to cut rates is a key moment in its fight against inflation, and it's aimed at ensuring a healthy economy. While the move signals optimism about inflation, it also highlights concerns about the job market and future economic performance. For now, the Federal Reserve is closely monitoring these developments, ready to take further action if needed. As borrowing costs fall, both businesses and consumers may benefit, but the real challenge will be ensuring that the economy remains balanced in the long run. Thank you for listening.